Well, good morning, everyone. Thank you for coming along and joining us today to go through the highlight of the federal budget 2019. My name's Tim Howard from the Advice Technical and Strategy team in at BT. Been asked to come along today to run you through what we observed from this year's federal budget and highlight some of the opportunities or at least what's on the horizon from the government as what they've proposed on budget night. I've been involved in a number of these budget reviews over the year in my capacity at BT. Looking at this one this year, it certainly had the flavour, as you'd expect, of a pre-election budget. So you did have the government going out there and highlighting or looking to highlight their economic credentials, and then off the back of that, particularly in relation to some of the tax cuts and tax concessions announced, looking to at least show that with the budget returning to surplus, with their prediction that they're going to look to pass on some of those savings to the people in that form. Interestingly, last night we also had the reply from the opposition, with Bill Shorten delivering his budget reply speech in Parliament. What we can say, at least from that, from a high level point of view, is that the Labor Party is going to be quite supportive of a lot of these tax cuts. They've got a view that at the higher end of the spectrum, they don't want to see as much benefit going to higher income earners, and they want to see a greater benefit coming to lower income earners, which is not unexpected. But what we do see from a budget reply is no particular details. We just have a budget reply speech. So what I'll focus on today is what was announced and what has been budgeted for by the current government. And then if we do get a change of government and an election, which will be due, which we're expecting at least in mid-May, there might be a change to this. So getting into it and getting things underway now, I'll just click to the next slide. There we go. What we're going to focus on today are three key areas that we identified. So first, taxation. I'll run you through the taxation announcements and what they do mean. Secondly, we'll look at superannuation and some of the superannuation changes that were announced in the budget. And then third, some of the incentives that have been offered for welfare recipients. So it's important, we always call this out up front, important reminders that these what we heard on budget night, they are currently only announcements. So when you get any announcement, any policy announcement or any budget announcement from any government or opposition, there's a series of steps that they need to go through before any announcement actually becomes law, and before that law is then obviously in effect. So a few of these measures would be expected to be legislated prior to the dissolution of Parliament. Some have been. Parliament has now raised. We don't expect Parliament to sit again before an election is called. You might hear an election called today or on the weekend. I think probably the start of next week is the most probable. From there, the successful implementation of these measures do require at least the current government to return to power. That would require, firstly, controlling the lower house. Any legislation needs to go through the upper house as well before it comes law. If you look at the history of the Australian Senate, certainly over the last 5 to 7 years, it can be quite fractured with minority parties having quite a say. So a lot of these announcements may be amended, changed, a few exemptions added, exclusions added, and so forth before they do become law. So just keep in mind the final measures may differ from these announcements. Okay, looking at the tax changes first of all. Now, the government announced last budget a series of personal income tax changes which were legislated and are in force. On budget night, they effectively came out and doubled down on that and increased a number of tax concessions and tax offsets for individuals. The first one we've got here, the low and middle income tax offset. Now, the way this works is people on a lower to middle income, although they are still subject to the usual marginal rates of tax and the tax scales that we're all generally familiar with. If you are on a low to middle income, there's a tax offset which offsets the amount of tax you pay. So the low to middle income earners actually have an extra reduced tax rather than paying at that full marginal rate. So the current rules, the maximum tax offset is $530. For those on taxable income, as you can see here, between 48 to 90,000, they'll get that full offset. 200 for those on taxable income up to 37, and then there's a tapering rate for anyone up to 90,000. So at the moment, under the current rules, there's no tax offset for anyone who earns over 125,000. Now, the proposed rules that came in on budget night, the government's going to double this offset, effectively reducing tax that the individuals pay on anything that they earn under 126,000. So you'll see on the right-hand side there, comparable tables, comparable figures, comparable reductions. But what that does mean is that this rule would apply to the current financial year. So they're looking to get this through, and you would expect it to apply this financial year, then going forward into next financial year and the year after. So whilst most of these announcements apply for next financial year or future financial years, this announcement will reduce tax, or the tax that low to middle income taxpayers do pay this financial year. So it's something that you're likely to see if you are in this income tax bracket. You're likely to see this apply when you do lodge your tax return for the 18-19 financial year. So certainly a good news story there for individuals. As I did mention up front, the opposition has said that they will support this change. So no matter who comes into government, I'd expect you to see this for this financial year and then the next two. In addition to the change in tax offsets, we've also seen a proposed change to the thresholds, excuse me, that you pay your marginal rate of tax on. So as you'll see here in the first column where we've got the red circle, this is a change which has already been legislated. So from 1 July 2022, you'll see the lower tax rate of 19% for $18,000 to $37,000 income earners. That will push up from 37,000 at the top end to 45,000. Similarly, proposed from 1 July 2024, you'll see the 32.5% tax rate come down to 30%, and then moving forward out from 1 July 2024, again, the 37% tax rate is currently legislated to be removed, and so you would have effectively a much lower rate of tax for anyone on that upper level of income. Now, while this is the case at the moment, it is a number of years out before we see those changes to the 32 to 30% rate, and certainly a number of years out till we see the 37% tax rate removed. That is something that the opposition has said that they would repeal, they wouldn't proceed with. So I think it would be probably unlikely that we ever get to a point in the immediate term where that second upper rate of tax is removed. But I would expect to see that to the lower to middle income earners to get those tax rates changed to go through and be supported by both houses of parliament. So again, we haven't seen individual marginal rates of tax change for a number of years until these rules came in from 1 July last year. So again, with the budget returning to surplus and there being a surplus available, we are now seeing that flow onto individuals and flow onto individual marginal rates of tax. So again, a great thing for all individuals out there. Overall, this chart does show us a tax saving in the 18-19, so again, the current financial year. What we're likely to see, the biggest tax saving there is for individuals in that middle band, 45,000 through to capping out at least at about 126,000. That is primarily driven by that doubling down of the low income tax offset, offsetting the tax rate that middle income earners earn, going from a $540 offset right up to just over $1,000, again supported by both sides of parliament. So something that we will see come through, and we will see come through from this financial year. And then again, you'll see tapering down that right-hand side, 87,000, 90,000 threshold change introduced last budget, and then the marginal rates of tax change we did see on that earlier slide. Other tax measures, low income tax offset, similar to the low and middle income tax offset. The low income tax offset sits right at the bottom of the tax spectrum. that's going to increase up to $700 from 1 July 2020. At that point in time, with the changes to the marginal tax rate, the low to middle income tax offset will effectively disappear, and the low income tax offset and the improved or the reduced marginal rates of tax will take care of things to the equivalent through the middle there for income earners in that space. The only other major announcement that we sort of want to call out here is for small business taxpayers. Now, if you are a small business and you do buy an eligible small business asset, the government has increased that threshold up to $30,000 from budget night right out to 2022. They've also increased the threshold for the definition of a small business from turnover of less than $10 million a year right up to a turnover of less than $50 million. So it does avail itself to many, many more small businesses to get out there to buy new machinery, buy new trucks, buy new other eligible assets, and effectively be able to write that asset off against their income in the current financial year or the next 2 financial years, if that's when they want to buy that asset. So the government there is effectively, as they have done many times in the past, incentivising small businesses to go out there, invest, create more jobs through that, employ more people and so forth. So continuing to push along with the policy initiative that the current government is certainly familiar with and regularly does do. Now, superannuation measures now, I did forget to mention up the front, if you do have questions as we go along today, by all means, add those questions to the text box over on the right-hand side. You probably got there. Then we were happy to go through. I'm happy to go through and take any of those typed in questions one by one at the end of the session. So by all means, get those in there. So superannuation, another big area. We've got 3 main changes which we saw come out on the super space. You might remember back in the 17-18 year, we saw numerous changes to superannuation. You tend to see a large amount of change to super about every 8 to 10 years. We had huge changes to super back in 1 July 2007, again 1 July 17. So because of that, there's probably less appetite and less desire to continue changing and tinkering with the super system. As a result of that, 3 main changes, all positive changes, that were introduced in the budget come last Tuesday. So those changes, first, removal of the work test for those individuals aged 65 to 67. I'll expand on that, but generally it means if you have retired around that age, you're now going to be eligible for a longer period of time to continue to put money into your super fund. In addition to that, extension of the bring forward contribution rules. So along a similar vein, allowing individuals at that age, if they're no longer working, to continue to put, again, larger amounts, after tax amounts into super. I'll run through that shortly as well. And also extending the age at which you can make a contribution for your spouse. So even though you may not be able to make additional contributions, or you want to look to balance up the amount of super you have in your household between you and your spouse, again, an additional opportunity there to do that for a longer period of time. So what's the work test? The work test is a test that requires anyone under current rules that to meet if you want to make a contribution to super after the age of 65. So the work test basically requires that from age 65, you need to have worked in the financial year at least 40 hours in any 30-day period before you're eligible to make a contribution to super. So that under current rules is for anyone between the age of 65, as I said, right up to the age of 74. So from 1 July 2020, in 1.5 financial years' time, the government wants to move that up to age 67. So what that does mean is even if you have retired and you are looking to make additional contributions to super, the fact that you're not working won't be an issue now between age 65 and age 67. From age 67 out to age 74, you would need to continue to meet that work test. But if you don't, we've got an extra 2 years to do your contribution planning, do your superannuation planning, and get money into super, even if you aren't working. So what this age 67, why that's relevant, that actually aligns with the age pension or the future age pension age. So at the moment, the age pension age is 65 and a half. That's going to push out to age 66 from 1 July 17. And then in 2 years' time, that'll be 60 6.5, and then ultimately age 67. So we are seeing an aligning with the retirement age in relation to super, aligning with the retirement age in relation to the age pension. So what it's going to do, again, like I said, make it easier for those who are retired, approaching that age, to put money into super without the need to work. And it's also going to create more opportunities for those at least under age 66 who aren't working to benefit from this age 67 push out or increase. So this is a good thing. It's probably something I didn't see in specific. The opposition leader did call out on this in the budget reply speech, but it is something I would expect them, hopefully, to take on board, because there's only a positive thing in relation to opening up the ability for more people to put money into super. Super is there to assist us to fund our retirement. It is one of the most concessionally taxed ways you can fund retirement. Any amount you take from super from age 60 continues to be tax-free. You can invest in superannuation when you retire tax-free, up to a limit of 1.6 million. So still a fantastic way to at least supplement, if not fully look to help with your retirement income. Extension of the bring forward rule. So the bring forward is around contributions we make to super after tax. So at the moment, anyone up to the age of 65 can put in $100,000 a year under what we call the non-concessional contribution cap. Non-concessional contributions are contributions we make with after-tax money. So that could be from savings that we've accumulated. It could be from the proceeds of sale of an investment. It could be from proceeds of a payment when you leave work, perhaps even an inheritance, perhaps even downsizing your home, whatever it happens to be. It's the ability to put in up to $100,000 a year after tax into our super fund. Now, the bring forward allows us to bring forward up to 3 years of non-concessional contributions. So currently, someone under the age of 65 can put in up to $300,000 in one go by combining up to 3 years worth of non-concessional contributions. With the age pushing out to age 67, the work test age, we'd accept that it also, as part of that measure, allows individuals up to the age of 67 to trigger that bring forward and put in up to $300,000 if they have the ability, or if they chose to do that into super. So again, that just extends the planning opportunity, extends the option that individuals have as they do just retire or as they're approaching retirement, to put some strategies in place and actually maximise the amounts that they can put into super. Now, you don't have to put in the full 300. You may have less than 100,000 available. You might have between 1 to 300 available, depending on what you're looking to doing and what your retirement planning might be. But the option is going to open up from 1 July 2020 again, if we do see this measure come through, to be a bit more strategic, or perhaps give you a bit more time to put those plans into place and get that money into that very, very concessionally taxed investment environment for your retirement. Effectively allows the value of non-concessional contributions up to the age of 69 to go in one go up to age 67, again, without working. So it's another opportunity for those who thought that perhaps if they are approaching age 65 that they don't have the opportunity or don't have the money yet to make these types of contributions. You've got a bit more time on your hands now, so planning opportunity really does open up there. So that's, again, a positive opportunity for people. Spouse contributions. Now, this is a bit of a unique one. There's a couple of reasons why you might want to look to make a contribution for your spouse. First of all, balance equalisation is a really good one. It's become more of a point of, or a strategy point, I should say, particularly since there's now a limit on the amount we can have in super. And once we are at a point where we're fortunate enough to have greater than 1.6 million in superannuation, you're not really able to put many types of contributions, many additional contributions in. So if you do have one member of the spouse who's approaching that, you can now look to put money into your spouse's account instead of your own. Currently, you can put money into your spouse's account non-concessionally, generally, as we've just spoken about, up until and including when they're age 69, but if they're between age 65 and 69, need to meet the work test. Now we propose that the proposal to extend that age to your spouse can be up to age 74. Work tests will still be required after age 67, but it does extend the opportunity for a spouse contribution for another effectively 5 years. So again, pushing out the age at which we can put money into super without having to meet an additional amount of concessions or eligibility criteria, I should say. Look, in addition to that, another strategy with spouse contributions, now you don't have to put in, the 100 or 300,000 if your spouse is earning less than 37,000 a year, so anywhere between 0 and 37. If you put up to putting up to 3,000 into their super account, you can get a spouse contribution tax offset to reduce the tax that you pay as an individual of up to $540. So whilst we saw some of those general offsets, low income tax offset, low and middle income tax offset automatically available to individuals at certain income levels, no matter what your income is, if you make a eligible spouse contribution and your spouse earns, like I said, under 40,000 for a partial contribution tax offset, under 37,000 a year for the full contribution tax offset, you can actually look to reduce the tax you pay as an individual just by making a non-concessional contribution for your spouse. At the moment, that tops out at age 69, but going forward from 1 July 2020, again, you can do that for a spouse right up to the age of 74. So additional opportunities there to top up not only your own superannuation, but top up that of your spouse as you do look to approach retirement, or if you have retired, can still continue to do that without needing to work for an extra couple of years than what we've got under the current law. Other considerations around this, the Downsize Strategy, you might have heard about this. This came in last financial year. It is an opportunity, or was announced last financial, let's just say it applies from this financial year, 1 July 2018, 2019. Now, the Downsize is a great opportunity for those individuals over the age of 65 to make an additional contribution to super under a downsizer contribution cap. So this is separate to all other caps that we've spoken about today. What it allows you to do that is if you do sell your main residence, so a home that you've lived in for the last 10 years or perhaps lived in for part of the period of the last 10 years, as long as you've owned it for at least 10 years and used it as your main residence for at least part of that period, or your spouse might have used it as their main residence for part of the period. When you do sell that after the age of 65, you are able to put in up to 300,000 of those sale proceeds into superannuation. So if you're a member of a couple and you've got an eligible property and you sell that property for greater than 600,000, both of you have the opportunity to put in up to 300,000 each. Now that's been good for those that are looking to downsize. Even though it's called the downsizer measure, you actually don't have to downsize to be eligible. You can move into a second house that you own, you can move into an investment property that you now want to use as your main residence, you can move into the holiday house, or you could go buy another house that's worth more than the one that you're living in now. That's of no concern. It's just a matter of selling the house amongst other criteria that you've held for at least 10 years and at least lived in it for some of that period. Now with the age of the work test going up, or proposed to go up from age 65 to age 67, we don't yet know if the downsizer age is also going to get up from age 65 to 67. So if you were looking to make a downsizer contribution at the moment in your age, or approaching age 65, age 66, it might be worth revisiting that and looking to do it sooner rather than later, or you might need to wait till age 67 to do that. That's purely speculative. We don't know if they're going to change that age, but we are seeing a trend of aligning certain superannuation ages to the age of the age pension, which is, as I said, creeping up slowly to age 67 by 2024. So that's something to consider. Second point we've got there is for self-managed super fund trustees. If you do have your own self-managed super fund, there is now greater flexibility in the way you calculate tax concessions. Now, you might think, look, don't really worry about this. For most people, you probably won't need to worry about that. Your accountant or your SMSF administrator will literally see to this for you. But it does make things a little bit easier when you are drawing a retirement pension from your super fund, from your own self-managed super fund, whilst having some accumulation money in there as well. So that's an improvement for accountants. The accountants out there who might be with us today will no doubt appreciate that. That's been lobbied for a while, but it improves the way that we administer our self-managed super funds if you do or are trustees of your own superannuation. Similar to that, there has been some changes for insurance in super, looking to be from 1 July 19. This is primarily around inactive accounts or superannuation for those who are under the age of 25. So there's been some improved definitions there around when an inactive account would be rolled to the Australian Tax Office, pushing out the period of time around how long that fund hasn't had a contribution, a few rules around if the trustee of that super fund hasn't been able to reach out and find the member, it really is genuinely lost super. If the balance is below $6,000 or it's a new account and the member's under the age of 25, there won't be default insurance in there. Default insurance in superannuation, while quite useful in a lot of cases, it does result in erosion of the member's balance as a result of the premiums being deducted. So those inactive accounts or those superannuation funds with lower member balances or younger members, there's just been some integrity tweaking there on what it does mean. If you do have an inactive account and you don't even know it does exist and you've never found it, and you do end up finding it one day that it has been rolled to the ATO, you haven't lost that money forever, or your children, perhaps younger, they haven't lost that money forever either. You can go to the ATO and actually apply to get that money back. What happens in a situation like that is you do your application to the ATO, you nominate where your current super fund is you would like that money to be rolled to, and the ATO will then re-release that money to you. So you don't lose it to ever. It's not an extra tax. It doesn't disappear. You can always go and get that money. Easiest way to go and look for lost super, and I always encourage people to do that, or encourage your children to do that if they've had multiple jobs over the years. Jump on the ATO website, do a lost super search. It's very easy, name, address, tax file number, and it will tell you whether there's any superannuation, any lost member accounts out there. Go and grab it, consolidate that money into where you keep your super at the moment. So do that, encourage people to do that. There's an astronomical amount of lost super out there, so some of them might be yours, so go see what's there. Okay, the final section today, just look at some of the welfare measures that were released. Minor changes, but obviously still important for income support recipients. The main one, this was called out a day or two before the budget, energy assistance payment. What this is effectively the government's positioned it is to assist individuals and couples with the higher cost of energy. As we have seen, electricity bills and gas bills have gone up quite considerably over the last few years. So if you're on an eligible income support payment, age pensions obviously the big one, a few of the other pensions and allowances are also included. Interestingly, the day after the budget, Treasurer Frydenberg did come out and say he's going to extend this payment to individuals who might be on New Start as well, spreading out the payments which will qualify. But what it does mean, as an individual, you're going to get a one-off payment this year of $75 or $125 going to a member or couple to assist them with funding or assist them with higher energy prices and their energy bills. Also announced has been a few tweaks, a few improvements and a few expansions for the funding of aged care. So that's both residential aged care as well as home care packages. More home care packages will be available to individuals. That's a really good thing. It's something that has grown a fair amount over the last few years. It means if you are getting older, you might have parents, or I've got grandparents, certainly have had grandparents in this case. They've got the option now to have a home care package. So rather than need to move into an aged care facility, need to find an aged care facility, need to work out how to pay the lump sum amount or pay the ongoing payment to get into that facility, there's a halfway option where you can get a home care package. Now, that home care package is subsidised by the government. If you are in a mid-means situation, it is means tested, but it does allow individuals to get a certain level of care at home, have nurses, have support, have help come and visit. You do pay for that, as I said, it's subsidised, but the individual does pay to a degree where they're able to afford that. but it does mean where you're able to stay still in the home, you don't need that round-the-clock care. People can now do that, and the government is continuing to fund and grow the options available there, which, again, having grandparents in my situation go through that, it is a great opportunity for people to still stay in the home, as a lot of people do want to do. Single touch payroll and benefits there, that is just around some efficiencies and some reporting obligations for employers, both from employers that report individuals' income back to Centrelink for people who might be on some partial income support, as well as employers reporting when they make superannuation payments for employees back to the ATO. Progressively, we are seeing live reporting of superannuation payments, as well as live reporting from employers of wages and salaries going to individual. First of all, this makes sure that superannuation is being paid on time and is being paid as it should be to individuals, which is a really good thing, and also will encourage engagement. I think for individuals who might be young and not really engaged with their super, they'll see, yes, I do have super being paid, know where it's going, and make sure those payments are going there. Because at the end of the day, for those younger workers, those superannuation, you may not be able to access your super for 10, 15, 20 plus years, but it is your money and it will be your money come retirement. So it's important to know where that's going. Some improvement there. So in summary for today, before, as I did say, if you did have any questions, by all means type it into the chat box there. I'm happy to take any questions that you might have around these topics. Significant tax savings coming. It doesn't matter which side of government gets in. Come either the 11th or the 18th of May, seems to be the probable dates of an election. We're going to see some significant income tax cuts for most individuals. Certainly anyone earning under 26-ish thousand a year will see a benefit. Increased super opportunities, particularly around the age we are approaching retirement or are retiring through our mid-60s, as well as some increased payments, energy supplement being the main one for welfare recipients as a one-off payment this financial year. But as always, still a case of wait and see what goes through and how things do go through Parliament, no matter what side of government gets in. You may have seen a number of policy releases from the opposition. The one that's got by far the most press is around the change to the refundable franking credits. If you do have excess franking credits from Australian shares, the opposition is looking to take that system back to how it was prior to 2001 and not provide cash refunds for excess franking credits, as well as some proposed changes to negative gearing and proposed changes to capital gains tax. So there'll be a lot of wait and see around a lot of those measures to come through. As always, it is really a state of how Parliament does form up under the election and what party does or doesn't control what parts of both the lower house and the Senate. But again, any questions, happy to take them now, but otherwise thank you very much for coming along to listen to the budget update that we ran today. Thank you. Okay, great. We've got one question that has come through from Harry. Thanks for bringing that question through. So, hi, Tim. I'll just repeat the question for everyone. Hi, Tim. Some of these tax cuts come in from 2022 and 2024. I'd assume that the government would have to win the next election after this one for those tax cuts to come into effect. So you're right. If you look at those tax cuts, they are more than two election cycles on the horizon. Importantly, these tax cuts have already come through. So the current ones that the government announced last budget, they got them through late last financial year. They're currently in place and they are currently legislated. The opposition has said they're going to reverse the higher end or reverse a lot of the 2024 cuts, particularly removing that 37% tax rate completely. So as a result of that, yes, you would probably need the government that brought this measure in to be in power either the next election or at least the election after, because the opposition has stated that they're going to wind this back. Any tax cut or any policy that's 7 years out, as it was when it was announced, is a long way to go. even as it is legislated as it has been here. The problem is, as you've rightly called out, you get another government, they change things, they just go and roll things back and amend the legislation. So I wouldn't be hanging on to those tax cuts out to 2024. Whilst they are there, yeah, I would agree that if we did have a change of government, we're likely to see a change to the 2024 changes. All right, well, thanks everyone. That's the only question we had came through. So again, I did appreciate you taking the time to come along today. I hope you got something out of it, and enjoy the rest of the day. Thanks very much.